Hello, and welcome to Arnerich Massena's Launch of the Decade MarketCast. The 2010s gave investors a big going-away gift as stock and bond prices soared to record highs. Will this trend continue in the 2020s? In this special Launch of the Decade MarketCast, senior research analyst Arthur Coyne and investment and philanthropic advisor Katherine Fox will not only recap the year, but more importantly, they will share with you our forward-looking asset class expectations for the decade to come. Thank you for joining us today.
Thank you, Brian. Stocks around the world rose about 9% on average in the fourth quarter, thanks to investor optimism over U.S.-China trade relations and the prospect that more central bank rate cuts are on the way worldwide. For the year, U.S. stocks led the way, rising 31.5% to a record high, followed by international and emerging market stocks. Moving down the risk spectrum, fixed income gained modestly in the fourth quarter and performed remarkably well for the year, thanks to strong demand. The U.S. dollar, however, didn't do as well. It lost ground in the fourth quarter as narrowing yield spreads between U.S. and foreign bonds drove investors to look at other currencies. So all this leaves us with two big questions. Why did stocks and bonds do so exceptionally well in 2019, and what's their outlook for the 2020s? We think this chart, which shows central bank rate cutting activity over time, helps explain why stocks did so well in 2019. Here we can see a dramatic step up in central banks around the world cutting their interest rates during the year. And while these rate cuts were intended to stimulate economic growth and head off recession, they were also beneficial to stock and bond prices, as was the case following the massive 2008 round of rate cuts after the financial crisis. Stocks and bonds generally appear more valuable when they're competing against a lower market interest rate. So with this central bank tailwind now in place, investors have good reason to be optimistic. However, that optimism should come with a dose of caution. Here in the United States, stock prices have moved so much higher in the past few years, we're now seeing an unsettling divergence between stock prices and corporate profits. In this chart, we can see that since 2014, stock prices have risen by more than 8% a year, while after-tax profits have been relatively flat. This raises the question as to whether U.S. stocks are becoming overvalued relative to their capacity to generate profits. The last time we saw a dislocation of this magnitude was during the tech bubble of the late 1990s. For a specific example, let's look at Apple stock. Like many stocks in the S&P 500, Apple's earnings were nearly flat in 2019. Yet its stock price rose 86%, and its price-to-earnings ratio nearly doubled to its highest level in more than a decade. And yes, Apple's 2019 performance was in fact helped by low interest rates, which made it economically attractive for the company to repurchase over $66 billion of its shares, a transaction that improved the company's earnings per share and benefited investors. And like many other companies, Apple benefited in the fourth quarter from news of an imminent U.S.-China trade deal. The net result? Apple stock nearly doubled in price despite stagnant profits. So when U.S. stock prices are as high as they've been, we can see the impact when we compare U.S. market capitalization to the rest of the world. In this chart, we can see that U.S. stocks make up 56% of the world's stock market. This level is well above the average since 2000 of 49% and almost as high as the prior peak of 57% in 2002. And when we compare U.S. sector weights to entire country weights, we see that the U.S. information technology sector now represents a whopping 13% of the entire world's stock market capitalization, more than the United Kingdom and Japan combined. While this may seem reasonable at the moment, things can change. For example, Japan, which is now valued at 7% of the world market, used to be an enormous 45% in 1990. In the United Kingdom, which is now valued at 5% of the world market, it had a 5 times bigger share at the start of the last century. So to guard against these kinds of shifts, we think it's important to diversify geographically by investing globally. So what is the investment outlook for the next decade? This chart shows Arnerich Massena's forward-looking estimates or expectations of each asset class's annualized return on the vertical axis and expected volatility, or annualized standard deviation of return, which is a rough measure of risk, on the horizontal axis. When we work with long-term investors, those who typically target a return of 5 to 7% over the next decade, these are the expectations we use to develop portfolios and calculate the projected ranges of an investor's potential outcome. Starting at the bottom left with conservative investments, we're expecting that cash and fixed income will likely deliver low returns over the next decade with relatively low volatility. Then moving up to the right, we see the asset classes with higher expected return and volatility. And then up in the top right quadrant, we find private market investments and international and emerging market equities, which we expect will be among the best performers over the next decade. And now, to look at our views on portfolio positioning, I'd like to introduce investment and philanthropic advisor, Katherine Fox.
Thanks, Arthur. U.S. stocks are continuing to set new highs. With this growth, we see opportunities to rebalance portfolios toward investments that are more attractively priced. This includes international equities, especially in emerging markets, and value stocks, which are trading inexpensively relative to growth stocks. Given the shape of the yield curve, we also favor low-duration bonds. We're maintaining our focus on higher quality credit. Where we do invest in credit, we prefer utilizing active managers who evaluate credit opportunities on a case-by-case basis. As always, your advisor will keep you informed about specific investment opportunities as they become available. Keep a lookout for our year-end podcast, coming soon. In this research-focused podcast, co-CIO and co-CEO Bryan Shipley and research analyst Ben Larson will take a deep dive into what happened in the markets in 2019 and our outlook for the investment landscape in 2020. Thank you for joining us today.